Welcome to the Money Mentors Podcast.
This week here on Money Mentors, we are continuing our special series as well on taxes. Now that you have your taxes done, it might be tempting to just file that return away in a drawer or on your computer somewhere and never look at it again, hopefully, if the IRS doesn't come calling. But sometimes this tax return is on that list of things that you and the team tell people to bring in for those first visits because it can tell you a lot of information. What do you look for in particular on these tax returns, though, to help someone plan for their retirement?
Yeah, from the get-go, the first thing is what was your total taxable income?
Okay.
That's one of the most important things because that lets me know what tax bracket you're in. There's several different tax brackets. It's not all taxed at 10 or 12 or 22 or 24. Each layer of income is taxed differently. But that total number gives me an idea of what your effective tax bracket would be. And as to what Maria was talking about is when we're making changes in the portfolio, right? I know what your total income was based off last year, and if everything else is the same, sometimes even though there's capital gains in the account, you may not owe capital gains taxes based off your total taxable income. So it gives me a little more latitude, especially when we've seen what's gone on in the market in the last 6 months. There's been some great gains. I don't want to just let them sit there and say, oh, I hope they stick.
Right.
I'm trying to harvest those, but on those non-qualified accounts, not talking about IRAs or 401ks, but these are after-tax dollars that are invested. If I just do that on a whim and don't take taxes into consideration, well, yeah, we may have a 10% gain, let's say, in a short period of time, but now I just created a 22% taxable event for you if I'm not paying attention.
That's the last thing, too, that you want is to be paying too much in taxes on particular investments. Or, as Gary points out sometimes, paying taxes on money that you're not even using in a particular year. That's a big frustration for people, too. But you and your team, you work with CPAs there. You work with preferred providers who help out with the tax part of things. But doing some of this forward tax planning, you've been able to save people a lot of money just by, identifying a few tweaks here and there, haven't you?
Yeah, one of the big ones is, with what's gone on with interest rates recently. Everyone's like, CDs at the bank, they're great. And I love them too. When you've got money sitting in the bank, either emergency fund, great. Make sure it's making something for you. Otherwise, you're just losing purchasing power. But that interest that comes in from a CD, that's taxable income. So if you're in the 22% tax bracket, which is total income above roughly $94,000 household income, every $1,000 you make, $220 is going back to Uncle Sam. And that's just from interest on a CD. So there's other investments out there where you can get just as good a return, if not better, but you don't have to have that taxable income tax at your income tax bracket. You could have it as a capital gains tax, which would be only 15%, if anything, versus 22. So you have to look at the type of investments and what your goal is for those funds, what you're going to need them for. All of this is taken into consideration when I'm building plans for my clients.
And I will say, kind of a caution out there, if you're one of those individuals to where you've been doing a really good job at saving in your 401k or your employer plan, you're putting money away there, you see it on your pay stub and kind of set it and forget it. Well, if you have this large sum of money in this pre-tax account, when you go to retire, that's your only asset. So every time you take money out, you're going to have taxes.
Right.
What happens if your Social Security is there, or if you get a pension, or there's layered other things in there and you don't need those monies? Come, required minimum distribution time in your 70s, you're going to be forced to take from that. And so you don't want to be in a position once you're locked in at 73 right now is the current required minimum distribution age, to where you have to take 3 or 4% of your portfolio, pay tax on it, and like to Dad's point, then it just sits somewhere else and has to be reinvested. Let's put a strategy together that makes sense, and maybe you have some charitable gifting that you like to do, and we can kind of layer that into the plan. But I highly suggest if you're an individual who's got that employer plan or that 401k, and that's your one solid asset, let's really start talking about how to diversify into different tax buckets and come up with a good plan.
And we do often talk about those 3 tax buckets here on Money Mentors, but most of us want to know, how do we get as much into the tax-free bucket as possible, especially if you just had to write a big check to the IRS? So the Motley Fool gives us a list of 3 different options here. I'd love to get your thoughts on these because tax-free sounds really good. Number one on their list, I think most of us have heard of this by now, but those are those Roth retirement accounts. A really good savings vehicle, right?
Yeah, I mean, you put after-tax dollars in, so you don't get a tax deduction benefit, but by putting that into an investment, not only is the money you put in tax-free, but any growth is tax-free after certain conditions are met.
Hallelujah, we need that for what's coming in the future.
Yeah, exactly. Look what's happened to tax rates, in the last 30 years. What's it going to be in another 30 years? Having that tax-free bucket, knowing that, generally speaking, you can always pull money out of there, and we don't have to worry about, the taxable income or the taxable consequence. It's not going to affect your Medicare premiums. It's not going to affect the taxability on your Social Security, whereas drawing from traditional retirement accounts like IRA, 401k, 403b, those could impact how much you pay for Medicare, how much of your Social Security is taxed. It's added income. So there's all these different layers that you want. We want you to have the income you want and you need, but we got to keep an eye on the tax man.
Yeah, that allows for a lot of flexibility there with your plan. And don't go running off and say, oh, I heard on, Money Mentors that they said I can take money out of my Roth account. There are some rules in there, right? Like waiting till you're 59 and a half, and if you've had your Roth for at least 5 years. So make sure this is one of those things that you want to keep track of. When did you open the account? What's the contributions you put in? Just so you have those details for your tax preparer as well.
All right, so get started on that. Again, that's part of that second opinion we're offering here this week, and on Money Mentors, doing some of that Roth math and understanding the rules there. Number 2 here on the tax-free bucket list, those health savings accounts. A lot of us have those in our workplace accounts, but a lot of people don't realize the tax advantages here.
Yeah, the HSAs are just another great vehicle that most Americans do fall under what's called a high deductible healthcare plan. So you have a family deductible, say around $3,500, but having that high deductible healthcare plan allows you to put money from a tax deferred standpoint into a health savings account, right? So you put $100 in there, you're not taxed on that $100 just like you're not taxed in a traditional 401k. The nice thing about an HSA, though, later on when you have say a medical bill you have to pay, well, if you take $100 out of your 401k to pay that bill, you're paying taxes on that. But if you take the $100 out of the HSA, it's tax-free income if it's used for a qualifying medical expense. So just like the Roths, we can put money in there, but you have to make sure that the distributions are done the proper way. Most advisors are trained on how to put money into retirement accounts. Not so many are trained on taking money out, which is just as important.
Key difference, too, in how they approach things at Matson Financial Services. And finally, number 3 on the Motley Fool list is their government bond income. How does that work tax-wise?
Yeah, when you're talking about government bonds, it could be at the federal level, like treasury bills, what we call T-bills. Any income made from that, they'll pay a certain interest rate. Like a 2-year treasury bill right now is paying around 4.5%, 4.75% annually. In 2 years, you can make 9%. Generally speaking, that is not taxable income then on your tax return. Now, if you went and got 4.5% CD at the bank, well, you're paying taxes on those dollars. But if you have the same 2-year T-bill, you get paid the same amount, let's say. Now that 9% that you made in 2 years, that is not taxable income. You can do that at the federal level with things like T-bills, or you can do it at the state or municipal level, certain cities, by buying government bonds. Most of the time, those are not federally taxed. Now, they may or may not be state taxed. Every state's a little bit different, so work with your CPA. But now you can still generate a good return because of what interest rates are. You can get good savings and not pay taxes on those dollars.
And that's why we look at your plans from an all-encompassing, a real holistic level, because if you come to us and you have a CD and you have maybe some T-bills and whatever else is happening out here, we want to see how those are layering into your plan. We don't want to make a total different plan over here, which doesn't communicate with what's going on this side, because it's your one whole plan. And when it comes tax time, it's all going to come together. So that's why it's really important to make sure your advisors are speaking with your CPAs or your attorneys, with your estate plans. So everybody's sitting at the table working for you, and it's all making sense for your plan.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Matson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Matson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Matson Financial Services is licensed in your state, please call 800-536-8907.